Afternoon, folks. Doc Severson here with you, Ready Set Crypto Trade School. Here it is on Thursday, the 1st of November. We're crossing into another month, and I am a short timer here. I am going to be hitting the road here in a couple of hours. We're going, should I say house hunting? I don't know. We're thinking of moving to a southern latitude, and need to find a place to live before we actually move there. So maybe that's coming up next summer. We'll see. Anyway, hope everybody's doing okay as we get into the end of the week today. And Trade School, what I'm going to talk about is something that may seem to be very innocuous at first. Like, what on earth are you talking about? What do you mean? Why does price move? Well, supply demand, right? Supply and demand. If there's more demand than supply, the price will go up. Well, that's true. And the converse is also true. If there's more supply than demand, then the price will go down. That is true. That is the first law of economics. But whoever said that has not traded a live market. It's combat, it's war, and you need to know the rules, the ground rules behind this, right? So price generally moves because of pain. Probably not something that you would expect to see. Like if you go to the local, let's say you're going to the local farmer's market, which meets every Saturday morning. There's supply, there's demand. People post their prices on their little booth, and you pay your prices, whatever. Most people don't haggle too much at those kind of things, and generally there's not that much price movement, right? There's very little elasticity of price. There's the price. You want it or not. If you don't want it, don't pay the price. Move on to the next booth. But that's not the way that financial markets work, right? It's much more combat involved. It's much more of this, I would say, some of the old style markets where you really truly get in there and negotiate the price. It really is war. And the ultimate expansion of that would be financial markets. Markets move because of pain, not just supply and demand, but mostly because of pain. The more heavily traded and more liquid that they are, the more they move because of pain. All of this starts because investors are looking for the safe trade. There is a very real purpose for having retail investors involved with every market, because you want retail investors to be involved with every market because they do very predictable actions. They are looking for the safe trade. And I hear it all the time. I get the phone calls, I get the emails, I get the Discord messages. What's the safest trade that's out there, Doc? I want to trade, but I want to do it safe. I want to be safe about this. I don't want to lose money. And so you tiptoe into the markets with that type of attitude, you will get your clock cleaned. You have to be aggressive with this, and I'm going to show you how to do this. And again, this is a very subtle point that I don't think is really taught anywhere. Nobody's really teaching you guys how, to sharpen your bayonets and dive into there in this fray that we call live markets. Now, luckily, it's sort of a quiet market right now, so you get a chance to sort of sharpen your saw and get up to speed with this before we truly get hand-to-hand combat. So what most retail traders are looking to do is to minimize their pain. I want the pleasure, but I don't want the pain. I want gains. I don't want any losses. So if that's your attitude about things, if you're trying to minimize pain, what you end up doing is you end up bringing more pain upon yourself. And that's this dichotomy that's out there, which again, will take you some time to internalize, is that you're going to be your own worst enemy for quite some time until you figure out how to stop doing that. And again, maybe today's session, which is oh so subtle, may be the very first way, the first step towards that yellow brick road kind of thing. So traders, retail traders will wait on the trade entry until it feels safe. This is usually when the trade's over. It's usually over by this point. By the time that you get a safe entry, it's done. But you don't know that yet. Your criteria is that you want something to feel safe. Again, maybe the operative word here is feel. If you're making decisions based on feel, then thou art a retail trader, and thou art a typical retail trader. So here's an example. This would be a price chart, and you're watching this go through, and you're starting to study these things. You're starting to say, oh, look at that, a pullback, and then it goes up, and then it pulls back, okay? So, boy, I wish I would have bought down here. Man, if I had just bought down there, I'd be in at 2,000, and I'd be up. Look at that. Almost 100% by now. And so you look at things like that in the rear view mirror and you say, why couldn't I have done that? Boy, I get all washed out when I bring up these white charts, don't I? I like tone it down a little bit. So this is what we go through. This is that little voice in the back of our head goes, why didn't you get in there? You knew you was going to do this. You should have gotten into it. And I bring up this point all the time, is that this is real pain. Watching a trade go higher without you is real pain. It causes real pain to your subconscious. So you say, all right, I'll wait for the next pullback. And damn it, I got the next pullback, but I missed it. This is driving me nuts. So watching a rally from the sidelines will drive you insane. It is actually much more visceral pain than taking a stop loss. So I'll definitely buy in the next pullback. All right, I'm, cross my heart and swear to die, I'm going to buy in that next pullback. Okay, I missed the next one, but this one feels even better. I finally got my pullback and I entered. So this one feels good, looks good. I like everything about this. Boom, I entered. And then this is what happens. So the trader punches out and says, well, this is not working. It's probably going to go down to zero now. And guess what? When they punch out, usually it could be a stop loss order. It could be just like, get me out. Just get me out right now. That's a market order. And if enough people punch out with a market order, that drives the price down. It's almost like a sledgehammer punching on the price. Because you're not submitting a limit order. You're not trying to be filled with whatever. You're saying, hey, here's the current price. Fill me down here. I don't care. I don't care. Push the price down to fill me. I want to get out of this. So when people punch out with market orders, this pushes the market. It will push the market one way or the other. This is how price moves. And it all happened because of pain. You were looking to avoid the pain, and the very act of you avoiding the pain meant that you get into a lousy position. And if I were to put an anchor chart up here, more than likely that would be an exhausted weekly chart. Shame on you. Buying into an exhausted weekly chart, you know better than that. But there it is. There's that visceral pain. Hey, but the trade's getting away without me. Every dip has been bought, so I had to violate that rule. No, you didn't. That's your filter to avoid chasing after something that's more than likely exhausted and will pull back even harder. So this is a weekly chart pullback. And guess what happens next? You guessed it. Don't look now, but you just missed out on the next move. So while you were sitting there with your head in the sand, licking your wounds, the price takes off again. And you're like, damn it. And this is the way the markets move. This is the pain that they create. All right. So new retail investors wait too long. So this is one of the first things that they do, is they wait too long for things to feel good. I mean, we see it every single day, whether or not you guys know it. I mean, it's just, we broadcast it out through our actions, through what we type. The Discord page is like a virtual petri dish of these types of conditions, of people saying, well, I didn't enter because it didn't feel good, and those kind of things. Well, what are your rules? Did your rules say to get into it or not? Well, it didn't feel good. Okay. You got to work that out of your system, because no entry is going to feel good. And in fact, the ones that do feel good will be the ones that you will lose. So you've got to start making that association between, if something feels good, then that means that you're going along with the rest of the herd, or you picked up a bias from somebody else and somebody else told you what to do. And so that feels good to apply along with somebody else. And guess what? You're part of the herd again. So I need you guys to start conditioning yourself that if something feels good, it's very likely going to cost you capital. So new retail investors wait too long to enter their positions. They wait until things feel good. You must focus on securing the very first entry onto that trend to get the price moving in your favor. Now, why is the price moving in your favor? Why was the price moving at all? Aha, it's because somebody else is getting burnt. Somebody else is getting burnt on this. So to get price moving, excuse me, let me turn off my noises here. So to get price moving in your favor as a bull, somebody else must suffer to get the price to move. Now, I know that this makes people uncomfortable. Well, wait a minute. I don't want to do that to somebody else. This is mean. That's really mean to make somebody else suffer so that I can win. Well, guess what, guys? This is combat. We're not here to be nice. We are here to secure gains. We are here to leverage our capital to get what we want out of this. And this is not a collective thing that we do here, right? So this is where we get into this notion that I call the trap. So let's see how the trap works. This is a beautiful example of a trap. So notice what's happened here is that we have the price on an uptrend, higher highs, higher lows. And all of a sudden, what happens is we have higher low, and then here's the flag. It's a lower high. It's a lower high, isn't it? And then what happens is it makes a lower low. So now we have a change in polarity on the daily chart. We now have started to move into a downtrend. And notice there's a little bit of what I call a bar fight right there. The bar fight starts in the bar, spills out into the streets, and there's a few people getting duked out up there. This is typical. At a trend line, you'll have a little bit of volatility, what I call a bar fight. And then it releases lower into a lower low. So we definitely have a downtrend on the daily chart here. So what happens is all the bears say, oh, damn it, I missed it. Shoot, I missed that move because it didn't feel good, right? It didn't feel good to short this market as it was screaming higher. So I missed that move, but I want to take the next pullback. I'm going to take the next pullback. So this bear thinks, all right, here we go. Here's the next pullback, and it's pulling down. I'm going to jump on and short this thing with both hands. There we go, man. I'm going to use my entire account. This thing is heading lower. This thing is toast. It doesn't belong. Bitcoin doesn't belong at $4,000 USD. Okay. Is that the first signal? No, it's not the first signal. It's the second signal. The first signal is back up here as it put in a lower high, lower low. That's the first signal. Now you're waiting for things to feel good. You weren't aggressive. This one did not feel good to enter. Did not feel good to enter. This one feels much better to enter. So what happens to this? As you might imagine, we break the trend line, makes a higher high, and all of a sudden squirts higher because all those bears are in pain. And remember, if you're a bear, if you take a short position, if you sell to open a position, how do you close it? You have to buy it back. And normally when you buy it back, you're not just sitting there with a limit order like, well, gee, I hope I get a good fill on this. No, if you're got a short position and you want to get out of a position, you're just going to punch out. You're going to hit that big D ring between your legs and pull it between there. You're going to go rocketing out the upper canopy, right? You're going to punch out of this position. You're going to get out. That is your job, is to get out when you're wrong. So you're not going to monkey around with a limit order. And guess what happens? It's not just you, it's everybody else that got in there. So what I want you to consider this, and I want you guys to study this. This is the trap. This is what I call a trap entry. Lower high, lower low, lower high. This is the next lower high, but all of a sudden what it does is it arrests the fall right there, now becomes a higher low, and the reversal happens right there with a higher high. And you're not going to be able to see this unless you do the hard right edge work for these. That's the reversal, and this is what bakes the bears. So the people that came to the party way too late that shorted this market down there, all of a sudden are scrambling like mad to get out, because all of a sudden the price is printing higher highs and higher lows, and some of them don't get out until up here, where it's like they're getting out at maximum pain because that's a new high. And they're really, really wrong, and they can't afford to be any more wrong. That's why price moves. Price moves because somebody is in pain. This is not your little local fruit stand market at the local, farmer's market, right? Where people are negotiating on price and there's pain involved and everything like that. No, everybody's very genteel, very nice. And you don't really even get this in a car dealership, right? There's a little bit of negotiation, but there's no pain involved. Financial markets are when there's winners and there's losers, and when you're in a losing position and getting roasted, that's real pain. And pain drives these decisions and drives the markets. So what I want you guys to start thinking about is, when you look at markets, ask yourself, who is getting hurt? Who's getting hurt here? Trend lines will help you. So things like this, you can look at these trend lines like this, where the price starts making lower highs and lower lows, lower highs, lower lows, and then it comes up to another lower high and it doesn't go anywhere, and all of a sudden, boom. Somebody is in pain right there. Somebody that was previously short is in pain when you get to that level. And the same thing happens if you have a market which is going crazy to the upside. All of a sudden, people jump in at the very end, and then as the price goes down, then you're feeling that pain. You're punching out by selling out the position. All right. So notice how the bears held the weak hand and had to cover it great pain. So when I say weak hand means that if you short right there, this is called a weak hand. You'd have very little in the way of paper profits to be able to protect that position. So in other words, literally, as soon as you get into the position, you start taking heat. So you have no protection there. Now, if you had shorted this market up here, you'd have a strong hand, because all of a sudden you've got paper profits, and it's merely a matter of you protecting as much of the paper profits as possible. So more than likely, you'd be blowing out of that position here, and this would be your gains would be right in this area here. That's your delta P, right? But so that's a strong hand position. Now, how do you get a strong hand position? You got to take an aggressive entry. So it's this dichotomy where you come into this business, you want to be conservative, right? You want to not risk a whole lot. You want things to be nice and genteel for you. And then all of a sudden, what you find is that because of the fact that you're looking for things to feel good, you take an entry down here and you're screaming bloody murder not long after that. And so everything works against you. So this is one of the things that you'll find in this business, is that those that take the aggressive entries will find out very quickly as to whether they're right or wrong. And they can simply, if you take a short entry up here, which is extremely aggressive, the reward to risk on this is terrific. And if the price continues to rally higher, you can very quickly punch out, and you're not really risking all that much at all. But if you're right and the price goes down, all of a sudden you can peel off some of your position, right? Peel off some of the position, take profits on partial position. You can hold this thing for longer, but if it prints a higher low and reverses into a higher high, boom, you're out. You've got a strong hand, and it's much easier to manage a position like that. So again, you're going to find a lot of dichotomies around this business, is that the aggressive entries that seem risky, like the one up at the top, is actually much more conservative than the supposedly conservative entry down at the bottom, which is actually much more risky. Doesn't make sense, does it? So you've got to work through some of these issues. And again, some of the people I'm talking to today will not get this point. And that's fine. This is what I consider to be a second order skill that comes to you with time and trading. But just think about this. I want this to rattle through your head, is that if something feels good, if it feels good at an entry, it's more than likely the wrong entry to take. If it feels like the wrong entry to take, if it feels difficult to take, then more than likely it may be the correct one. Okay, so let's finish up here. So again, we talked about the weak hand. Investors have recency bias. Recency bias. Recency bias means that if you have a downtrend like this, so we have an uptrend and all of a sudden it runs into a downtrend and yet reverses, there's your first entry back on right there. There's your first entry back on, but your vision, your attitude, and your focus is still fixed on this. Like, yeah, but it was just selling off a couple of days ago, and it's probably going to do it again. It's probably going to do it again. No, it has absolutely no correlation to what happened a couple of days ago. This is a new day, right? So we have this thing called recency bias, which kind of grounds us in what happened next. I've watched the last 10 years of people with their recency bias thinking that we were going to have another October 2008. And we've gone through 10 straight years of equity markets just kind of ripping to the upside. And everybody keeps looking over their shoulder, waiting for the next financial crisis to hit. And maybe someday we will get one. You know, eventually, if you keep playing the same thing, you'll eventually be right. Johnny One Note, okay? So price moves because a big group of people thought that they were taking the easy trade, and they got punished. So figure out who has the weak hand and position yourself against them. Take the trade that does not feel good. Okay, that's all I had for today. That was, again, a seemingly innocuous point, but leads to a second order skill. It is not something that's easy. It's not easy to teach. It's not easy to learn. It's something that you sort of have to live through and get through your head that the simple entries, the ones that you think are more conservative, are actually much riskier. And you're better off taking the very first possible entry that you can into a new trend. Tig, is this approach all based on reading price and volume rather than fundamentals? Absolutely. Yeah, everything in my world is all about price and volume. So fundamentals, again, fundamentals to me is the longer the time frame that you're looking at something, the more that fundamentals will play a very real part of what's happening with the price. So fundamentals over a long enough time frame will override what's happening at the price, because you'll have, but at the same time, if your focus is on the very next tick, you're going to miss the point of that. You're not going to be able to handle that. So a lot of people out there say, yeah, I'm into fundamentals. I'm a fundamental investor, but my God, it's down $1 today. What's it going to do? Why is it down $1? It can't do that, right? No, you can't have this. You can't have your cake and eat it too. If you're a fundamental investor, you basically have to ignore the price. If you are a trader and are focused on price swings within, say, a 30-day time frame, then fundamentals have very little effect on what's happening on a day-to-day basis. So you got to pick a side. You got to pick what type of investor, or you can have one bucket of capital, which is fundamental, and you just leave it alone and you fundamentally invest in there, and you don't even look to see what's going on. And you treat that differently than your trading bucket of capital. Okay. Any other questions, guys? I know you guys have a lot of, you guys are watching the Malta thing. Again, I don't really have any comments on the Malta thing. I was not watching it. I don't know what types of presentations. It's kind of hard to understand what's going on if you're not there, if you're not watching every moment of it. I'm not, because I'm getting ready to get out of here. So I will not be around tomorrow. So I won't be in the Discord room and I doubt that Mav will be either because he's out in Vegas doing the trade show out there. So, Crixo93, do you have any suggestions regarding literature on this sort of topic? You know, I really don't. All these things that I'm talking to you guys about are things that I've had to learn over the years and just pick up. And it's through just kind of like day after day after day. You know, if you know who Malcolm Gladwell is and his 10,000 hours of movement. I mean, I can show you this stuff just briefly here. Let's see if I can find something to show you guys. Oh, let's see. Where is this chart? Bear with me a minute here. I'm going to bring down this chart and show you like a potential move that I saw this morning. So this is the S&P 500. Okay. S&P 500. And this is the type of movement that we see all day long, every day. You know, so here we are. We have a price chart moving to the downside. It's moving to the downside. Lower lows, lower highs, moving to the downside. And let's see, where was I? Let's see if I can find this. And typically this happens around a trend line break. Then all of a sudden you get a move like this. And there we go. And here's your higher low. And then off she goes. And this is kind of where we went long right there. And, you know, it just takes off. But if I waited for things to feel better, if I waited for full confirmation of this, then I get caught in all this chop and crap that's up here. I mean, the price is price. It doesn't matter what you guys are trading. It doesn't matter whether it's a futures contract on the S&P 500. It doesn't matter if it's Bitcoin. It doesn't matter if it's Genesis Vision token. It doesn't matter if it's an STO. It doesn't matter, you know. You're going to have different forms of liquidity. Things are going to move faster than others are, depending on the speed of that market and how much money is in that market. But once you learn the skill of trading, and once you learn how to read price action, everything is the same. Doesn't matter what you're looking at. They're all the same. All the same. Okay. The DGTX presentation was underwhelming. Okay, and I don't know which chart that you're referring to. Still having trouble seeing how the first lower low after the peak is lower than the previous uptrend's lower low. Let's see, Ty. Ann, I'll wait for you to tell me what chart that I was. Yeah, it is easy to see in retrospective. This is why you need these skills to be able to trade off the hard right edge. Doing everything off the hard right edge, I mean, this is what we do, right? This is what we do. We're always looking at this going, okay, here we are, we're in a downtrend. We're in a downtrend making lower highs, lower lows. What would I do to get into the next, what's the next way to get into an uptrend? Okay, so here's this lower high has now been taken out. So that's a warning flag. That's a warning flag. So now I want to go long on the next higher low, and it comes all the way down to here, and then it reverses. That's the next. There's a higher high. Here's a higher low. Off she goes. Off she goes. She's out of there. So, I mean, just learning to read price action like this. Learning to read price action like this, where you're just going lower highs, lower lows, lower highs, lower lows. What would have to change? Well, first of all, would have to break this trend line. That's warning signal number one. But see, the point is that today's point is that people are going short down here. They're waiting until things are feeling good. And then they get squeezed out. And then, so all this move is just merely pain from people that entered too late in the party. That's what happens. So understanding how to read things. So, Tig, I think that price action is, now his question is like, could you read this based on candles? Well, you could, but candles are all just a micro view. Candles are a micro view of what's going on here. When you put all the candles together and understand the trend, I think the trend is actually a bit more powerful. Candles are great for identifying maybe when this is reversing into an uptrend, but I can simply put a price level up there and say, well, look, if it breaks this trend line and if it breaks out through that price level, I just want to take a buy stop and take myself long into this. Oh, okay. So the first black and white chart that I had. Okay, the first black and white chart that I had. All right, so let's go back to, let's see if I can understand what you're asking here. Still having trouble seeing how the first lower low after the peak is lower than the previous uptrend's lower low. We don't care about the previous uptrend's lower low, right? So here's what I'm looking at. And this is let's go out to presentation mode so we can make this more bigger. Okay, so I think this is what Ann is asking about. When you have an uptrend, you have higher highs, higher lows, higher highs, higher lows, higher highs. Okay? Everybody with me so far that this is a series of higher highs and higher lows. Now, what happens next is you have a higher low. So if you're looking at the hard right edge, you don't know that this thing is going to puke over here. Your first clue, though, is that the price comes up to make a lower high right there. Uh-oh. Uh-oh. And remember, what we're doing is we're boxing in the price action. We have a high, we have a low. We've boxed in the price action. We're saying, all right, for this to remain in an uptrend, it's got to break above the previous high. And to verify that and to confirm the uptrend. Otherwise, if it breaks out through the bottom of this box, it turns into a lower high and a reversal. Lower high and a reversal. This is not easy, guys. This is where you have to train your eye to think forward in terms of this. This is something that you'll see in reverse, but to understand how to do this, use the single time frame, frame in the price deal. Okay? All right, so what happens is that once we put the frame in here, yeah, it does come through here, and eventually, after a little bit of a bar fight, tags through here. That would be potentially your very first short entry is on a sell stop into that trade. Okay, so after, I mean, it would be super aggressive for you to short the lower high right there without confirming that you have a change in polarity, because until this cuts through the bottom of this range here, you don't have a change in polarity. You just have range expansion moving to potentially range contraction, which is going into this, but it actually contracts so far that it goes through the bottom of the range. So that's your first entry into the short. The second entry into the short is the pop up here to next lower high. And now you get to draw the box all over again, don't you? Because now you have the next box here. You have highs and you have lows, relative highs and relative lows. So we know that if we want to continue the downtrend, we have to cut through this level down there. Otherwise, what could happen is this prints a higher low, blows through the top of it. You don't know what's going to happen. What makes this so hard is that all of you have a bias. You think you know what's going to happen next. And that puts a lens on your eyes that prevents you from seeing what actually does happen until it's too late. But the tail of the lower low is still higher than the last lower low. I don't care about this. I don't care about that. This is right there. This is the new and improved higher low. That's the new and improved higher low. I don't care about this one. I don't care about this one. I don't care about this one. I don't care about this one over here. I don't care about this one or this one or this one or any of these over here. This is the only one that I care about. This dude right there, right there. That is the most significant, that is the most recent higher low. And if that is taken out, then you have yourself a downtrend. You have yourself a downtrend. Okay. So guys, I could go on like this all day long, and I want to wrap this one up here. So thanks everybody for hanging out with me today. Trade School. There's always something to talk about, isn't there? This is not the easiest thing in the world, right? Understanding price action. Once you get this though, you're done. You're done. You're done. You're done. Once you understand how price moves, you are done. You don't have to learn anything else again. Just get better and better and better at this. Work off a single time frame to begin with. But what I talked about today is why price actually moves. It moves because somebody's getting hurt. Figure out who's about to get hurt, and you got something. You got something there. All right, guys. You guys have yourselves a good rest of the day, Thursday and Friday. And I will see you soon. Aside from my soul. There goes a sight, there goes a sight. Now there goes a sight from my soul. There goes a sight from my soul. There goes a sight.